Prashant Khemka joins us now. It gives me great pleasure to bring him on board. He's founder and CEO of White Oak Capital Management, managed assets worth nearly $2 billion. He's running one of the largest offshore fund of India. Prashant, fantastic to have you back. Thank you for joining us. Prashant, given that we've had a relentless rally, a great move, a trailblazing comeback in equities, at a time when the concerns in a sense are well discovered, well known, best of the bulls are saying that this is too good to be true and markets are only going higher because of liquidity and central bank policy action. Do you think this market right now is running way ahead of themselves?
I think if you think about it, it's been some such version of the story for last 11 years now. Since the Lehman crisis, when the markets bottomed out in early 2009, globally, I mean, particularly, US, people have been talking about markets being ahead of themselves, it being all liquidity driven. There have been so many acronyms or new phrases that have been coined, QE or quantitative easing or taper tantrum or some cliff or the other, Grexit, all these fears have come along the way where people have been looking for the next Lehman around the corner or behind the pillar and all along blaming liquidity or quantitative easing for driving up where the valuations are. I think these are all, related to market timing or market-wide views, which have very little predictive powers. If you were to look at this time frame of 11 years, where in 2009, most macro gurus would have been unanimous in calling US the next Japan, Japan being acronym for going to hell in a breadbasket. It's since then been the best economy, best equity market, and best currency. So every one of those have been proven wrong by the market. And the way I look at the markets and what makes me think, I don't have any strong view on where the market is headed, and I think nobody has a clue. But one way to think about multiples is that these are all relative. All valuations are relative. And the ultimate benchmark is the US long bond yields. When I went to study in the mid-90s to the US, the bond yields were in 6 to 7%, depending on the maturity that you pick. So if you invert that, the bond multiple was 15 to 17 times. Right? At that time, the market S&P 500 multiple was also around 15, 16 times. Today, the bonds have gone to yields as low as 0.5% to 1%. So if you were to look at the multiples, they've gone like 50 to 100 times of bond multiples. Market multiples increase, but to 20x equity market, right? I'm not suggesting they ought to go to 50 to 100 times.
Right. Fair point. So let's look at India from 2016 and 17. Indian markets have topped out both in terms of the P multiple which they were commanding in 2015 and 16 and also in terms of earnings. So for someone who's looking at investing in India after 5 years of a drought, what should be the return expectations? And do you think this years of underperformance what Indian markets have done on a relative basis is behind us? The next couple of years India could be on the other side of the spectrum, which is outperform not only developed markets but the peer emerging markets also?
What I tell clients worldwide, and we are always in dialogue with them, and not just now, but even 10, 20 years ago, what I always maintained is India is most attractive market for alpha generation or the potential for outperformance. Not necessarily for the market return itself. At any point in time, ex ante, it's reasonable to assume the Indian market would deliver the same return in dollar terms as the US market or any emerging markets or whatnot within, let's say, a percentage point or two. over prolonged periods of time that tends towards the nominal GDP growth rate of the country. It has done so in the US, it has done so in most of the developed worlds, it has done so in India as well. When you think of 20, 30, 40-year time periods, and going forward, I don't see why it would be any different. What is different is the inefficiencies of the various markets. India is a far more inefficient market than, let's say, a developed market like US. And there have been many studies done comparing Indian market not only to developed world, but also to many emerging countries. Not too long ago, Wall Street had published one of these studies. And study after study show that Indian markets provide the opportunity for generating higher alpha or outperformance compared to other markets. And since the total return is composed of market return plus the outperformance, if the market return is the same for all, if you buy into that argument that ex ante reasonable to assume all markets to generate similar return, then the difference in total returns between various countries would come from the alpha generation. And if it is higher in India, then a manager can generate higher total return in India than can generate in US. And hence you have many managers, very good, well-performing managers in India, not just ourselves, who have over the last decade or two generated higher returns in dollar terms compared to the comparably ranked US managers, even though the Indian market might have trailed the US markets by a few percentage points. And that's one reason why, while I lived 11 years in the US, from 95 to 2006, and invested money for clients in the US market, I had personally all throughout been invested in the Indian market because of the alpha potential that has always existed and continues to be so even today.
Prashant, a very important part of your theme, or I would say the heart of your portfolio composition, is that you have invested in companies like Asian Paints, Nestle, which are big beneficiaries of market share gain. Where do you think the market share gain is going to be an ongoing process? And just to draw a parallel for our viewers, what we are trying to understand from Prashant is, let's say if you bought into telecom companies 20 years ago, you benefited because all the telecom business from public sector moved to private sector. It currently is happening even in the banking sector. So Prashant, how do you propose one can really capitalize on this market share gain or market share shift theorem?
No, very good question. I would say, see, at all times, there are companies in any sector who are either gaining share or losing share. There are many companies who structurally are able to gain share over prolonged periods of time because of certain core advantages, you may call them competitive advantages, that they might possess. These advantages could be related to number of attributes. It could be as simple as execution capability, execution DNA of the organization. In industries or sectors like, let's say, private banks, obviously there's a brand and there's a network of branches effect, but those also, their brand and networks in many or most of the most successful cases has been on the back of superior execution over multiple decades. IT services, as an example, there's hardly any edge from brand or intellectual property in India, but execution can be a big differentiator. There were many companies back in early 90s and late 80s which were similar in size or not too far apart from companies like Infosys or Wipro, TCS or HCL Tech. Whereas fast forward 30 years, many of those companies no longer exist, which did not execute well. Whereas companies, these other successful companies that I mentioned, have created tremendous wealth for investors, and that is on the back of relative market share gain, I would say. So our portfolio, generally speaking, you're right. The characteristic is it's either industry leaders or dominant players, and typically, regardless of their position in the industry, these are market share gainers on back of strong execution DNA of the organization, which allows them to grow faster than the economy and the corporate sector in the industry, while maintaining, very importantly, growth in itself is not useful unless it is accompanied by superior returns on incremental capital. These are companies where, while growing faster than industry, they have superior returns as well as good and adequate corporate governance.
Prashant, you also have a very large exposure to consumer staples. Now, some would argue that if you're investing in names like Asian Paints, Nestle, these are expensive stocks, these are great businesses, good franchise, but if you're buying them at these valuations, the scope of making money may be perhaps limited and restricted. So are you not cognizant of valuations which some of these companies have to offer?
Certainly, valuation is very critical to investing, very integral to every investment decision that we make. So I'm glad you raised this question. And by the way, the team manages a fairly well-diversified portfolio. While they have investments in staples, retail, banking, but also have investments in healthcare, IT services across the spectrum, they're able to find very exciting opportunities. We on valuations, when you come to particularly, we are a highly valuation sensitive approach. Though we may not look at the standard metrics that most people use. So we never look at PE multiples, for an example. The team may evaluate companies, decide to buy some, own them for years, and eventually sell out without ever mentioning the PE multiple. What we focus on is value as well as price to cash flow multiple based on our proprietary, what we call clear framework or capital light excess investment return framework, where we, for every company, decompose it into two entities, FinCo and OpCo, where FinCo is just the invested or dump capital and the OpCo represents the excess.
Market price is a function of EPS into PE. Very simple. So if you have to break it down for our viewers, where do you think there is scope for EPS to go higher, which is underlying trend for earnings is strong, and where do you think there is scope for PE to go higher, which is a function of liquidity and perception?
Certainly. So great question. I like the way you frame it, and I completely agree. But I just want to caveat one thing, that the fundamental law of finance or valuation is value is equal to present value of future cash flows, or you can write cash flow divided by R minus G. Now you can translate that into some form of thumb rule, which is PE multiple. And there's a linkage between PE multiple and those cash flow multiple. And you can then translate that over a long period of time, it would be earnings growth multiplied by change in PE multiple plus the dividend yield is what would be the change in market ka value or any individual company ka price and the returns therefrom. So if you ignore for a minute the dividend yield, as you said, and focus on EPS growth and PE multiples, again, you'll have to go specific stock by stock, company by company basis. In every sector, you will be able to find companies that can substantially outgrow the marketplace from an earnings growth perspective. And even if in such companies there is multiple compression, the combination of the two over time can deliver strong returns. And there are other companies where multiple might neither grow nor decline, and yet the earnings growth would be fairly robust and can deliver strong performance. And yet there would be companies where there is potential for some multiple expansion as well on top of strong earnings growth. I can't talk specific examples, but let's take private banks currently have been quite beaten up post the COVID situation. It is possible if things were to normalize in a couple of years or sooner, possibly 12 to 15 months, while in the interim, these companies would have credit costs that would be at higher levels than what they've historically seen. But once they're past the stronger franchises, the stronger quality franchise, and granular asset book, good quality asset book, these banks have the potential to gain market share, and not only deliver higher earnings or cash flow growth, but also a benefit from multiple expansion, to cite one example of what you asked.
What is the view on financials? Because if you're bullish on India, you have to be bullish on financials, because financials will have to do all the lending. But there are some who also believe that, look, Indian banking sector is in a structural challenge, which is that PSU banks are getting weak. And for private banks also, there is going to be an NPA cycle which will kick in once the moratorium window will get lifted. Banks will have a challenge of dilution and return ratios will remain subdued. So where do you stand? Do you think a large part of the structural gains are behind us?
Certainly. So first of all, again, there are sectoral problems that would affect to varying degrees to the various players. As I was saying, 25 years ago, a lot of them got licenses. Some of them have gone bankrupt or had to be bailed out, yet others have created lakhs of crores of franchise value, despite being in the same sector, private bank sector. And going forward over the next 25 years, I'll be very surprised if that is not repeated. That some of the current players struggle, whereas others continue to thrive, or new ones who thrive and create tremendous shareholder wealth. So while we may talk at an overall sector level, but I would want to re-emphasize the importance on the individual names. So for private banks, yes, all kinds of private banks are likely to see higher credit costs over the next year or two, or maybe even three, because we've gone through a very difficult time in the economy. But is it something that's going to surprise the market? Is it something that investors are not baking it in current prices? I don't think so. That's the reason why private banks collectively are down about 33% year to date, despite the market being down, single digits now. So the challenges are there, but the better run banks would face fewer challenges, would have lower credit costs, and might surprise the market positively on the on the degree of credit costs that they face.
Mr. Khemka, good to have you on the show. We'll leave it at that. Thank you so much for taking the time out and joining in. Quick take.